We have a stock market rally on our hands, 10-year yields 220, gold down, oil's up. So it doesn't seem like there's a whole lot of concern. I'm thinking that the market has these expectations in place, that's consensus, that there is a slowdown in factory orders and in the whole industries in general, but that will turn around. And it seems like right now nobody seems to be concerned with it.
We know obviously this week is a big week of data, Larry, but with the Fed obviously stressing December will be a live meeting, data over the next 6 weeks, not just this week, will be the key focus for markets. I guess the question is whether all of this data will in fact justify a rate move by the Federal Reserve.
Yeah, I think they will. And you know, I've been really on the mark of thinking that they're going to raise rates in December. I think if the numbers that come out between now and then are no worse than feared, we definitely have the conditions in place to raise rates. And I think a lot of it is the Fed is just giving the market time to adjust to it. And we've seen that even in the last couple of days where Fed futures are now implying over a 50% chance of a rate hike in December. Last week it was in the low 30 percentile.
I wanted to ask you about, I guess, the correlation that we tend to see between the US dollar, those commodities, and of course those assets. Do you think that those relationships there might start to be challenged, I guess, as we head closer to a potential Fed tightening?
Interesting question, because, you know, and as you know, commodities is a very broad term, but when we look at like industrial metals, base metals, perhaps it's a time where maybe they're overextended on the downside, and so maybe a good time to be bottom fishing in that area. And I'm talking about nickel, steel, iron ore, et cetera. But in terms of the U.S. dollar, I think the dollar clearly has a valuation problem, and part of that problem is, in fact, the perception of the slowdown in the commodities arena. We have to keep in mind that this economy just was bad for commodities. It doesn't mean that our economy is just going to go into the fire or into the basement. It's just one of those things where it's not a commodity-driven economy right now. So all that to say, yes, I do think the dollar does have a valuation issue, and it is playing out as we see against some of the majors.
Larry, Paul Bloxham here. Do you think, I mean, the Fed if the Fed gets going in December, do you think we're going to see a follow-up through next year? What sort of profile have you got in mind? Is the Fed going to be very, very cautious and very, very slow, or are rates going to rise a bit faster into next year?
Yeah, Paul, that's a great question, because so many people are worried about when the Fed is going to raise rates. And I'm only worried about it because they said they were going to. Whether it happens, I mean, I want it to happen in December because that's what I think. But going forward, people seem to be missing, at least in the U.S., they're missing the trajectory of rates going higher. And that's something that the Fed is going to be very, very careful in watching, being very data dependent. And in fact, I think consensus has long-term rates much higher than they'll actually be. And I'm talking 1 to 3 years from now. I mean, I think it's going to take a long time for this economy to work itself through the system. So long-winded answer to that is, yeah, I think data dependency is order for the day.
So, Larry, if we do in fact see that growth momentum improving and we do head closer to a potential Fed hike, where should investors be positioned? I guess what assets do you expect would outperform?
Well, I think right now it's important to be tactful as opposed to being strategic, and just maybe managing expectations and realizing that the days of 10% returns on income are probably not anytime soon. Lowering those expectations to lower single digits. I do think that there's plenty of time still to get into some corporate yields and into treasuries, even though that goes against a rate hike. But I think, again, the normalization process is going to take a while. When it comes to the stock market, I still prefer Europe and Japan over the U.S. I think there's some value in the U.S., but not much left relative. I want to go where the liquidity is going, and that's in Europe. And I think cyclical stocks would be the call for the day. Lastly, I think gold. Gold took a $20 hit today. As a trader, I wouldn't buy it yet. But as an investor, there's no reason why you shouldn't have it in your portfolio. We just don't know how this all is going to end up.
Larry, what about your outlook, I guess, for where markets are headed from here? Because obviously we know they've had this exceptional rally over October, now starting off November on a very strong note as well. The S&P 500, I believe, really rebounding close to 13% from those August lows. Do you think this rally on the broader market can continue?
I don't. I mean, I think it's overshot. From the very beginning of the year, I thought 2050 in the S&P 500 was a good year-end target. I looked like a fool by the end of January. I looked like a fool again. But when I look at valuations the multiples of our stock market, and they continue to go lower. People are talking about the S&P 500 at $123, $126 a share. That puts us at a 17 times multiple. That's too rich for my blood. It's not to say it can't go higher. But if we have a correction, the correction is going to be fierce compared to when multipliers are down by 15 times.